Hello and welcome to today's masterclass where we are going to be talking all things pensions. I am joined today by our financial planner Dan, who is going to share some of his wisdom.
We'll see how wisdomful it is.
It'll be fab. Just before we get started, I do have to point out that the content within this webinar is of a general nature and is no substitute for tailored advice to your circumstances. And obviously, if you need further advice, then please do get in touch for a more specialist consultation for you and your situation. So let's start off with one of the questions we get is all around auto enrolment. So we have our clients ask us, do they have to set up auto enrolment for their team?
Okay, so every employer in the UK must put their eligible staff into a workplace pension and pay into it. There is a legal duty to do that from the moment you employ your first member of staff. So no matter how long the company or organisation has been running for, as soon as you take on your first worker, you have automatic enrolment duties that you must comply with straight away. The duties apply from the first day that the new member of staff starts their employment, and this is generally would be referred to as your duty start date in any paperwork or correspondence you have with the pension regulator. That's what they will be referring to. If you employ at least one person, that means you're in classed as an employer, and by law you've got responsibilities to act. Even the most complicated and interesting area that comes with this is, even if you think you won't need to put staff into a pension scheme, there is still duties you've got to complete. So you will always need to assess your staff to see if they meet the eligibility criteria for automatic enrolment. You need to write to them to tell them how they're affected and complete a declaration of compliance. Automatic enrolment is a complicated area. There is a certain order and processes you need to follow, and there are also things as an employer you can and can't do. So I always find that it's best to seek advice to make sure you're following auto enrolment rules correctly. Unfortunately, it's an area that isn't actually regulated, so the advice that you receive isn't always what you would hope. So yeah, it is best to seek advice from a trusted source to make sure you're following the rules.
Cool, thank you. And I think, yeah, our clients definitely find they need that advice and help, and us as accountants are not allowed to advise, which is why obviously we partner with yourself. So another question that we get is, should I just go onto the auto enrolment scheme as a director?
Okay, so again, this is an interesting one, and has quite, well, it depends what you're interested in, I suppose. But this is an interesting one because there is certain circumstances as a company director that you will have to be automatically enrolled. So if as a director you've got an employment contract and at least one other member of staff who can also be a director, and they have an employment contract as well, you're all going to need to be assessed for automatic enrolment. If you only have directors on the books and you don't employ any other staff, whether you're going to need to automatically enroll, again, depends upon your duties and whether you have an employment contract. There are cases that you will be exempt from automatic enrolment duties. Even if you do have an employment contract, you can still be exempt in some scenarios, as you might not necessarily be classed as a member of staff. But if there's more than one director and no other staff, and at least two directors have employment contracts, then again, you're all going to be subject to automatic enrolment duties. It's a really complicated area, and it essentially comes down to what relationship the director has with the business and how that relationship is formalized. So is it an employment contract? Is it something else? Will dictate on whether you need to be automatically enrolled or not. But again, it's a complicated area, so you're going to need advice to whether that applies to you or not.
Yeah, no, cool, thank you. So as a director, what would be my best options for pension? So do I do it personally or do I do it through the business?
Okay, so one thing just to add, sorry, with the auto enrolment bit is just also bear in mind that auto enrolment pensions are regulated by the pension regulator. So it's a completely different set of rules and boundaries that you just need to follow. But in regards to best options for a director, it really, I always feel like it's a little bit of a cop-out saying this, but it is true. It really does depend upon your personal circumstances. But it is gonna, because everyone's tax situation is different. The way, you know, the way you as an accountant might have set up how they're paid is different, so that will really dictate on the best way to pay into a pension. But if we start with a different way of tax treatments for personal and business contributions, that will give you quite good understanding. So a personal contribution is paid after you've paid tax and national insurance. So you take that tax money, you put that back into a pension. When you make that contribution into the pension, you'll get basic rate tax relief added by the provider. So they'll go to HMRC and they'll claim that directly. So just as an example, if you put £8,000 from your pocket into a pension, you'll get £2,000 tax relief from HMRC, equating to £10,000 going into your pension. If you're a higher rate taxpayer, you'll be able to claim a further £2,000 by your tax return based upon the £8,000 example. A business contribution obtains tax relief completely differently. Rather than enhancing the amount that go into your pension, it actually reduces the corporation tax that the company pays. So if the business paid £8,000 into the pension, £8,000 will go into the pension, but the business will be able to reduce the corporation tax paid by £1,520, which is based upon 19% corporation tax. And that your contributions do satisfy wholly and exclusively rules, which your tax office and accountant will be able to help you with. Obviously, if you've got a good one like Pink Pig. The option that is right for you does depend upon your personal circumstances, because there is circumstances that actually a director might be better paying personally or through the business. So it really does depend upon your circumstances to what's the most tax efficient for you, but having an understanding of how the two work and interact helps. So that's overall understanding.
Cool, thank you. And there's some maximum contributions and things as well, isn't there, that a business or a person can make into a pension? So do you want to talk us a little bit through that?
Yeah, so this is I keep saying this is an interesting one, and again, it depends upon what you find interesting, but technically speaking, there is no maximum you can pay into a pension.
I've learned something new there then.
But there are limits to the amount that you can pay into a pension and receive tax relief, and avoid what's called an annual allowance tax charge. But this differs depending upon whether the contribution is made personally or via the business. So if I explain to you how it's calculated for personal and business, it will help kind of set the scene. So for a personal contribution, tax relief on a personal contributions are restricted to the higher of 3,600 or 100% of your UK relevant earnings up to the annual allowance, which I'll come on to the annual allowance in a minute. Those figures are gross and include tax relief that you would receive. But it is all based upon what your UK relevant earnings are. There are areas of income that do not count as UK relevant earnings. So this is buy-to-let income, investment income, and dividends do not count as UK relevant earnings either. The annual allowance for the current tax year, so 23-24, is currently 60,000. But before that, it was 40,000 for the previous 3 tax years. You may be able to pay more than this, depending upon your personal circumstances, but essentially, we're kind of working with that annual allowance figure. If you were to breach the annual allowance, then you will pay what's called an annual allowance tax charge. This is essentially reclaiming the tax relief that you would have received that you are not technically entitled to, if that makes sense.
Yeah.
So it's not an extra charge. It's basically reclaiming the tax relief that you're not entitled to because you've gone over the annual allowance. It is important to note, and I know I've said it once already, but I'll say it again, that personal contributions, the tax relief does count towards the annual allowance. So if you wanted to put in 40,000, for example, it would be 32 plus tax relief. So, and that's how it would go up. Business contributions are not restricted by UK relevant earnings, but they do need to satisfy wholly and exclusively rules and requirements to receive tax relief. But business contributions still do count towards your annual allowance. So employer contributions over the annual allowance could still be subject to annual allowance tax charges, or there is another type of charge called a money purchase annual allowance. But without absolutely boring everyone about the nuances of the two, basically one is you are contributing to a pension and building your accumulation over time. A money purchase annual allowance is you've accessed your pension and you're trying to put more money back into it. So one is lower than the other. You can use carry forward, can be used to avoid any annual allowance tax charges, but whether that applies to you or not, it will depend upon your personal circumstances.
Oh, thank you. And obviously you've mentioned carry forward a few times there. So how does that all work?
So carry forward is a terminology that I don't like, but therefore that's what it's called. I can't really get around it. Carry forward is when you take annual allowance, so that 60,000 this year and the 40 in the previous 3 tax years, you take any unused allowance from the 3 previous tax years and you bring it forward to the current tax year to enhance the amount you can pay into a pension. So let's think of an example for this. So let's use the name Jane. Jane's a good, yeah, let's go with Jane. Right, so Jane has been running a company for, let's say, 2 years. Is now in a position where cash flow is not so much of a problem and money is starting to build up within the business. Jane has a salary from the business of 12,570. I wonder where that figure's come from, and the rest of the money is made up of dividends. Jane has a pension from a previous company that she used to work for, but it's looking at options, maybe it's setting up a new one. And as Jane has built up some savings personally and money within the business, after seeking some advice, is looking at placing some money into a pension. Jane has had a pension for the previous 3 tax years, which is an important point to notice. You cannot use carry forward if you've not had a registered pension in those tax years you are bringing forwards from.
Yep.
If that makes sense. So you're going, as long as you had a pension scheme in those years and you haven't used any unused allowance, can potentially be brought forwards, which basically means Jane can take advantage of carry forward and any contributions that weren't made in those previous tax years. Let's say Jane has not made any contributions in 2 tax years, but on the 3rd tax year she paid £6,000 into her pension. Based on that, Jane could carry forwards 174,000 if you include any tax relief that could be applied, which is a nice figure that Jane could get out of the business or, you know, from personal savings. This is where it gets interesting, and the nuances of personal contributions and business contributions can interact, because if Jane wanted to use personal savings, she's going to be limited by UK relevant earnings, which we've said the only salary income she receives is 12,570 from the business. So that's what she's going to be limited to personally that she can put into her pension. But from the business, that would not apply. So as long as the business has the cash to make the contribution, and it would not put the business into any financial struggles, Jane could take 174,000 from the business and place it into a pension subject to meeting wholly and exclusively rules. The nice advantage to this is it would attract a reduction of corporation tax of about £33,060 based upon 19% rate of corporation tax, which is quite a nice benefit. Let's just say that Jane decides to make a reduced contribution of, say, like 74,000 from the business. Due to how carry forward works, it would go, she would use up her current tax year. So we're in 23-24, she'd use that up first. And once that's used up, go back to the furthest it could possibly go. So go back to the third tax year to use up any unused allowance on there. So based upon the assumption that Jane puts in 74,000, she'd use up all her annual 60,000 annual allowance for this tax year, and she'd use 14,000 from the 2021 tax year. It's carry forward is a great one because it is very much if you don't use it, you lose it, because every year tax year that goes by, you move the tax year on. So you lose the capability to use any unused allowance from the previous one. But there is a lot of nuances with carry forward. And I would urge you to seek advice and professional advice on this, because if it's got wrong, it will be costly.
Yeah, very, very true. And I think that relates to many things, actually. So we have got a little bit of small print as well. So over to you for small print.
Yeah. So it's just really important just to bear in mind that a pension is a long-term investment. It's not normally accessible until 55, which is going to move to 57 from April 2028. The value of your pension may fluctuate and go down, which could have impact on the level of pension benefits available to you. So again, it's just important to seek advice.
Yeah. Oh, thank you so much. That's really, really helpful. And I think there's some really interesting information in there to help people start thinking about pensions and what's right for them. Yeah, so thank you very much for your help. If anybody does want to have a chat to talk about their specific circumstances and what they could do with their pension, or to set up a pension, what would you say to them? Or how can they get in touch with you, should I say?
I definitely would say seek advice, because there is impact to, it's important to consider what would have the biggest impact on your retirement going forwards. So best way to get in contact with me is all my details will be in the description of the video, but you can email me at Daniel at pigfp.co.uk, or give us a call on 07970 545469.
Fabulous. Thank you very much.
Thank you.
Thank you for sharing all your wisdom today with us on pensions.